In this video, we're going to conclude our discussion of ratio analysis. Again, remembering that ratios give us a relationship, right? We're going to look at one line item of a financial statement compared to another. And there are many, many different relationships, and some of them mean very similar things to companies, but in different industries, they have different importance. So this next set of ratios we're going to look at are what we refer to as solvency ratios. Again, they talk about the ability for the company to survive. The way I like to look at this, I think it's easier to understand, is that the debt to asset ratio tells us how much debt does the company have. It's total liabilities divided by total assets. We'll talk about this a little bit more. The times interest earned number says, can I pay? The free cash flow number gives us similar information. Free cash flow tells us how much money is left over after I've paid all of my operating expenses, after I've purchased all the assets that I want to purchase, and after we pay cash dividends, how much money is left over. Now, I will tell you that there are different formulas for free cash flow. So when you read this number, especially if it's on a financial statement or an annual report, you need to know what the formula is to understand the total meaning. Most of the time, we don't include cash dividends. Free cash flow typically means all the cash that's available to pay out to our investors. So that means interest on bonds, cash dividends to our shareholders, buying back debt, and also buying back stocks. So again, there's lots of different definitions, all similar meanings. So let's look at the debt to asset ratio. Total liabilities divided by total assets. So what does this tell us? Last year it was 81, now it's 78%. So 78% of assets are purchased with debt. Right? That is a substantial amount. Now, is that good or bad? I don't know whether it's good or bad. It depends on how they manage this, right? Compared to giant mills and the industry, they have substantially more debt. Is that, again, I keep coming back, is that good or bad? And the answer is, I don't know. What I do know is that they are in a riskier position, right? If something happens to sales and sales are declining for some reason, then we may have some concerns about being able to pay back our debt. Now, it doesn't, on the face, it doesn't necessarily mean things are good or bad. Let's go to the times interest earned ratio. Net income plus interest expense plus income tax expense. Again, this formula changes from textbook to textbook, company to company. In general, it just says, look, can I make payments on my interest expense? So in this case, we went from 6.0 to 5.8. Well, think about it. We have less debt, but now we also have less money or less of an ability to make payments. Again, not much, but a little bit more. Giant Mills has a better TIE ratio. They have a greater ability to pay their debt. But if we remember, they also have much less debt. So you would hope that they would have a greater ability to make payments. What I find interesting here is that we are actually better than the industry on average. So we have, again, if I just go back one line on, right? We have a lot more debt, but yet we have a better ability to make our interest payments as they come due. So I don't know what is causing that situation for this company, but managers will understand that, right? That this company is handling the amount of debt they have. They are handling it very well compared to the amount that they have. Next. So here we have our free cash flow number. So cash provided by operating expenses, capital expenditures, and cash dividends. Now this is sort of a exception, if you will, to the idea that we should be having a division here. This just represents how much cash a company has to cover these kinds of expenditures. So for the company, last year was 507, this year 556. So we have now what? More cash that we can pay for interest, to buy back debt, to buy back stocks, or invest in other things if something should come along. Now we also recognize the Giant Mills is much higher. Right? I don't know how to compare those numbers, right? You can't really compare them and say, well, Giant Mills must be doing much better, right? Maybe this number, we're expanding operation, 472, right? If Giant Mills is not buying plant and equipment, they have a higher number than us because we are buying. So we're expanding and they're not. So you really can't make direct comparisons between these two line items, but they do give us information. They certainly give investors, shareholders, and bondholders, they give them information about their ability to pay them the money that they're owed. Finally, we're going to look at profitability analysis, and there's quite a few of these. So as we go through, let's just think in general about what we're trying to measure, right? Is the company controlling operations, right? So let's go through this. So again, we're looking at what a given period of time, right? So why is this important, right? It affects our ability to get debt. If you don't have profits, it's very difficult to get debt. It's very difficult to have liquidity. If you don't have cash coming in, how can you have liquidity? Creditors, investors are obviously interested in profitability. Analysts, ultimately, this is a test of how management is effective. For me, that's just another word of how well do they manage? How well do they control the business? As you see, we have several different ratios that we'll look at, and we'll go down the line and talk about all of them. But let's first of all think about something called common stockholder equity, right? What return do investors get? Well, this return comes from two things. It comes from debt of the company, right? This is the debt to asset ratio, but it also comes from the return on assets. Where does return on assets come from? It comes from profit margin and the asset turnover. This is efficiency, right? This is a number that kind of measures efficiency, and this number measures control. So let's think about this. How can we get more money to our, more returns to our stockholders? We increase our control, get better control, or we become more efficient. That will make this profit number increase. The last part, a little harder and a little bit deeper than this class needs to go, is we can increase the leverage of the company. Increase the debt of the company itself will help us get more money to stockholders. So let's think about stockholder equity, the return, right? This is that ROE, right? It's just net income minus preferred dividend divided by the average common stockholder equity. So we see what's happened to our company. We've gone from 46 to 48%, a little bit of an increase. But look at what we're doing for our share compared to our competitors and the industry. So we're doing a great job. So this kind of goes back now to our discussion of debt. We have a lot more debt. So how are we doing? We have a better TIE ratio, which means we have enough money that we should be able to make payments, but we are converting that into returns for our investors, particularly for our shareholders. So we're doing a much better job profitability-wise if you think about our common shareholders. Return on assets. Again, we're at 10%. We were at 9.4. We're getting better. Again, look at how we're comparing to the company that we're looking at and to the industry average, right? Again, both of them certainly is not negative, so it's positive is better than negative, but we're performing better when we think about return on assets. Now let's look at profit margin. We're at 9.4. We were at 9.2. Obviously, we're getting better. 3% better. 33% better than what our industry average is. And we're a little bit better than Giant Mills. So again, on the profitability side, we have 3 measures so far, and we are doing much better than what our competitor and what the industry is doing. Asset turnover, net sales divided by average total assets. I like to think of this sometimes as being an efficiency number, right? If you kind of think about this ratio, we purchased a bunch of assets to do our job, and we're creating sales with that business. Did we choose the right amount of assets or not? The bigger the number, the more efficient we are. And you can see here, we've increased our efficiency since last year, and we're definitely better than what the industry and our competitor are doing. So again, as a profitability measure, we are controlling our assets much better. A little while ago, we had a graph there that showed this, and this kind of pulls all of this together, right? To think about how we're overall controlling the return on assets, right? So if you take the profit margin and multiply it by the asset turnover ratio, right? So multiply those numbers, right? That's going to give us, that gives us, this should be an equal sign. This thing is incorrect. This should give us then the number we want over here. And if you think it's just, right, if you multiply profit margin times asset turnover, net sales divides out. So now we have net income divided by total assets. That's how do we get a better return on the assets that we've purchased? Again, as I mentioned earlier, you need to control better, or you need to be more efficient with the assets that you've purchased. So again, that's just a connection between these two profit ratios and this ratio. What about the gross profit rate? Again, you can see we're at 44%. That's where we were last year. We're doing well. And again, compared to the company in the industry, we are doing much better, right? So again, this one is all about production. Are we producing our products at a reasonable cost? And relative to industry and a competitor, we are doing this at a much less expensive cost overall. As a bottom line number, we have something called earnings per share. Everybody has heard of this number. Just net income minus the preferred dividends divided by the weighted average of shares. So for this company, we had around 418 shares is what they said. We have no preferred dividends. 1103 was the net income. So Our earnings per share is $2.63. Last year it was $2.40. So obviously, profit per share has increased. Compared to Giant Mills, it's a little bit lower, but what could cause it to be lower? Maybe Giant Mills has fewer shares. If they have fewer shares, then even if they had the same income, right? And we know they don't have the same income, right? We can look at that up here somewhere. Where's their net income? It's up here somewhere. Let me find it. It's right. Where's it at? So they're 1103. Well, we don't have their numbers, so we can't make that comparison. But again, all we know is what one is bigger than the other. We're not sure why. Maybe they have more net income, right? Maybe they have fewer shares. We don't know the answer to that. The next ratio is kind of a important number. In the investments world, this number is very important. This number tells us how investors feel about a company's future. And the reason we talk about investors' assessments is because we're talking about the market price per share. Investors, through their buying and selling of stocks, create the market price. So if investors really like this stock, everybody's going to want to buy it. That drives up the demand for the stock, which means the price is going to go up. So this number just reflects how investors feel about the profits of the company. So in this case, 20.1, we know that what? It went down. I don't know why it went down. Maybe it went down because earnings per share decreased. All right, maybe it went down just because the price went down. Who knows, right? But compared to the industry and the competitor, we also see it's a little bit lower number. So what does that mean? The higher the number, the greater investors' assessments. So bigger numbers, let me just write this down. Bigger numbers could mean overpriced. If the number gets too big, it could mean that investors are putting too high a price on this particular asset. Doesn't mean for sure, but it could mean that. So when investors are looking for stocks, they frequently don't look for high PE stocks. They look for low PE stocks because that means investors are probably being a little bit more conservative about the actual value of the company. And finally, we have the dividend payout ratio. And I have to tell you, I'm not sure why they have this as a profitability ratio. What it measures is, of the income that the company has created, how much of that did they pay out in dividends? I mean, dividends are not a measure of profitability. Net income certainly is, but dividends are not. So in this case, Chicago is maintaining or is paying out about 43% of its earnings. Giant Mills is paying more. Both of them are greater than the industry average. I don't know how you relate that to profit, because this is really a choice of management. Management decides what to do with the profits. They either pay it out as dividends or they reinvest it in the company. So in this case, we can see that Giant Mills is paying out more, which means they're reinvesting less. Chicago's cereal, right? They are paying out less of their profits and maintaining more so that they can maybe buy more plant and equipment. Maybe they're investing more in inventory or whatever. We talked about there could be some expansion going on. They're keeping the earnings so that they can buy things. So again, this is a very short summary of financial analysis and ratio analysis. I hope to see you in another video. Take care.